Hey everyone, welcome back to Corporate Decoder, the place where we unravel the secrets hidden in plain sight. And today we're diving deep into NetApp's latest quarterly report. Get ready because we're about to see if their data infrastructure game is as strong as their financials suggest. So this is NetApp's quarterly report telling us how they did financially in the last 3 months. It's like a checkup for the company's health, and we're going to read between the lines to see what's really going on. Let's start by looking at their balance sheet, which is basically a snapshot of what the company owns and what it owes. Think of it as a company's net worth at a specific moment. Right now, NetApp has about $2.1 billion in cash and things that act like cash. That sounds like a lot. But compare that to April, where they had over 2.7 billion, so their cash pile has shrunk a bit, which we'll see why as we go through things. They also have 1.2 billion in short-term investments, which is up from about 1.1 billion earlier in the year. This shows they're keeping some money available for quick use. But here's an interesting one, accounts receivable. That's essentially money owed to them by customers. It dropped quite a bit from 1.2 billion in April down to 787 million now. This could mean they collected more money from customers or sold less on credit. Their property and equipment, which are things like buildings and computers, went up slightly to 570 million. It's not a huge jump, showing they aren't making massive physical investments right now. Goodwill, that's a figure that shows up when a company buys another company for more than its books are worth. NetApp's goodwill is around 2.7 billion, and it's slightly increased, suggesting they might have made or are valuing acquisitions. All this ownership is then broken down into their segments. Looking at their current liabilities, which are debts due within a year, they've decreased from over 4.6 billion to about 3.6 billion. That's mostly because they paid off a chunk of their long-term debt. Speaking of debt, long-term debt stayed the same at just under 2.5 billion. However, a big portion of it, 750 million, was due in April and has now been repaid, which is why their current liabilities went down. NetApp actively managing its debt. On the equity side, they have over $1 billion in common stock and paid-in capital. The number of shares outstanding has gone down slightly, which usually means they've been busy buying back their own stock. Now let's look at how they actually made money. This income statement shows their revenues and expenses. Their net revenues, which is the total money they brought in after returns and discounts, are 1.5 billion for this quarter. That's a small increase from 1.5 billion in the previous quarter. It's pretty steady, but we need to dig into where the money is coming from. Product revenues, which is the sale of hardware and related software, went down a bit to 654 million from 669 million. This shows a slight dip in their core hardware business. But their services revenue went up to 905 million from 872 million. This is the good news for NetApp, showing strength in their ongoing service contracts and cloud offerings. This shift from products to services is a common trend for tech companies. Their gross profit, which is what's left after they pay for the cost directly tied to making their products and services, stayed exactly the same at 1.1 billion. This means that even though product sales were a bit lower, their services side picked up the slack perfectly, keeping gross profit flat. Now let's look at their operating expenses. This is the money they spend on running the business, like sales, marketing, and research. Total operating expenses decreased to 789 million from 816 million. That's a positive sign, as they are managing their spending well. As a result, their income from operations, which is the profit from their core business before interest and taxes, went up to 309 million from 282 million. This shows they are becoming more efficient. And finally, their net income, the bottom line profit, decreased slightly to 233 million from 248 million. While income from operations went up, other factors like taxes likely caused this small dip. This statement tells us how cash moved in and out of the company. Net cash from operations was strong this quarter, coming in at 673 million, a significant jump from 341 million in the prior quarter. This indicates healthy cash generation from their core business activities. On the investing side, they spent 181 million. This was mainly on buying investments, which is higher than the 51 million they spent on investments in the previous quarter. So they're putting more money into investments. Financing activities show a big drain of cash, with 1.1 billion used compared to 548 million in the prior period. The main reason for this massive outflow is the repayment of that 750 million debt, plus another 300 million spent on buying back their own stock. They also paid out 104 million in dividends to shareholders. All these activities resulted in a net decrease in their cash reserves of 658 million this quarter, bringing their total cash down to just over 2 billion. It makes sense given the large debt repayment and stock buybacks. Now, let's touch on some of the specific details about how they manage their talent and reward their employees. Executive compensation and stock-based awards are a big part of how these tech companies attract and keep top talent. They're granting performance-based restricted stock units, or RSUs, which means employees earn stock based on how well the company does. Some of these are tied to how well NetApp performs compared to other companies in their industry, and others are linked to company financial goals like billings. This shows their strategy to align employee incentives with company success. In terms of cost, stock-based compensation was 83 million this quarter. This is a significant expense, but it's in line with the 85 million they spent last quarter. This is a normal part of doing business in the tech world. And about that stock buyback we saw in the cash flow statement, they repurchased over 3 million shares this quarter for about $300 million. They also have another $1.1 billion authorized for future stock buybacks, showing they're committed to returning value to shareholders by reducing the number of shares out there. They also continued to pay dividends with $0.52 per share declared this quarter, totaling $104 million in payouts. This consistency in returning cash to investors is a sign of financial stability. NetApp organizes its business into two main parts or segments called hybrid cloud and public cloud. The hybrid cloud segment is pretty much their bread and butter, offering storage solutions for companies that want to modernize their own data centers. It includes hardware, software, and support services. In this hybrid cloud segment, product revenues were down slightly, mainly because fewer companies bought their older hybrid systems, though they saw some strength in their all-flash array systems. Support revenue in this segment remained pretty steady, while professional and other services saw a nice jump, likely due to their Keystone storage as a service offering. The public cloud segment is their newer venture, offering services delivered mainly as a service right on platforms like Amazon, Microsoft, and Google Clouds. Public cloud revenues grew a little, helped by increased customer demand. However, this growth was slightly dampened because they sold off a part of their business called Spot by NetApp earlier in the year. Looking back at the cost of product revenue went up by 12%, largely because the cost of components, like the parts that go into their storage systems, also increased. This squeezed their product gross margins by about 6%. On the services side, the cost went down by 9% overall. This was mainly because the costs for their public cloud offerings decreased, thanks to cost-saving measures and the sale of that Spot business. Their sales and marketing expenses fell by 2%, mainly due to lower spending on employee costs and outside services. Research and development expenses also decreased by 4%, primarily because of lower employee costs. This might suggest they are being more cautious with new spending in this area. However, general and administrative expenses went up by 12%, mostly due to higher employee compensation costs. And while we're talking about costs, let's look at taxes. For the quarter, they paid about 11 million in income taxes. Their effective tax rate was around 23.4% this quarter, up from about 17% in the same period last year. This increase is partly due to changes in tax laws and how they handle stock-based compensation. They're also navigating new global tax rules which could impact them in the future. Overall, NetApp ended the quarter with over $3.3 billion in cash and short-term investments. While this is a healthy amount, it's down about $500 million from the start of the year, primarily due to those debt repayments and stock buybacks. They have more cash held internationally than in the US. They also have off-balance sheet purchase commitments of about $1.3 billion for inventory and other supplies. This shows they are planning for future production and sales. On Squirrel Licks, I'm shifting my take on all this. Overall, NetApp seems to be navigating a shifting market pretty well. They're successfully moving more towards services, which is a smart long-term strategy as hardware margins can be tight. The increase in operating income and cash from operations is a good sign of business health. However, their product revenue dip needs watching, especially as component costs are rising, which is eating into their hardware profits. The big cash outflows for debt repayment and stock buyback show they are actively managing their finances and returning value to shareholders. While their cash reserves decreased, they still have a substantial amount, and their credit lines provide a safety net. A notable risk is their reliance on a couple of big distributors, Arrow Electronics and TD SYNNEX, who account for a significant chunk of their revenue and receivables. If those relationships sour, it could impact NetApp significantly. In terms of direction, NetApp is clearly pushing towards cloud and as-a-service models, which aligns with industry trends. The slight increase in R&D expenses usually points to investment in future growth, though the slight decrease this quarter warrants attention. They face competition and changing customer demands, especially with the rise of AI workloads, and how they adapt to those will be key. For now, NetApp appears stable, but they need to keep a close eye on those hardware margins and continue to grow their services and public cloud offerings to maintain momentum. Alright, that's our breakdown of NetApp's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.